Today's guest brings rare perspective. He scaled fixed income and debt assets at Aditya Birla Sun Life Asset Management from under 10,000 crore to nearly 1.6 lakh crore. As founder and CEO of Mosaic Asset Management, he is shaping a new approach to credit investing. Most of what you need to know about bonds begins here.
Proudly part of the 01 network by Zerodha.
Welcome Manish, welcome to the show. While having nearly over 2 decades of experience, what do you think is the biggest misconception every retail investor has when it comes to debt instruments?
So one set of people actually think that debt means fixed deposit. These set of people are super cynic and they think this side of almost do not have this belief that there is something more to be earned beyond fixed deposit. And then there are sort of a tiny set of people who think that they're very adventurous and then they're kind of acquiring all sorts of assets, simply maximizing yield. I guess both of them are mistaken. There is a lot more to extract from fixed income, but also be aware of the fact that fixed income also, even though it's called fixed income, comes with a lot of risk. So we should hopefully discuss all of this today, but yeah.
There's also one misconception that people take bond equivalent to FDs.
People are both right and wrong in this. Right, that yes, if you bought a 3-year bond, let's say any A-rated bond, they've bought at 11-12%, it will deliver 11% every year and it will also return capital to you. But as I said, there is always this small risk that the company actually goes bankrupt. In the end, investors' job is not simply to maximize yield, but also know as a matter of fact that each of these firms have some bankruptcy risk baked in. So as I said, they're both right and wrong simultaneously.
Why would you suggest anyone to pick bond over FD?
One is simply to increase yield. That fixed deposit today in India will give you 6. If you make a decent portfolio, not very difficult to earn 9% or 10%. So in a sense, there is a significant delta or extra yield that you can make over fixed deposit by actually buying into bonds. I just still want to emphasize that be aware that there is always a risk, but bina risk ke there is no return ever. It's just that as long as you have a sort of clarity of what kind of risk you are undertaking, and if you're diversifying the portfolio significantly, there is a real risk premium that you can make. So that's one advantage. The second advantage with bonds is also that they tend to be relatively more liquid. That you could on platforms such as Wint, but many others, you could potentially exit from these bonds. Not as easily as you could do to equity, but it is possible to exit without much of an impact cost. And so to that extent, it also offers you a little bit more liquidity. Combine these two, a higher yield and a little bit of an extra liquidity, I guess there is a case to make that they are actually good alternative to fixed deposits.
When it comes to investing in a corporate bond, what would be the 3 things that they should be looking after, keeping yield aside, of course?
I think in bonds, you have to obsess over risk. You have to obsess over that, the firm that you are investing in, that it does not go bankrupt. Yeah, because that's the only primary risk that you're running there. So the first thing that will come to my mind is that look for leverage and ask these simple questions on one of the Gemini or ChatGPT that what is the leverage of this firm? Is this more levered than many other companies in the same sector? And leverage, by the way, is a firm killer. So invariably, more levered a company is, higher the chances of bankruptcy. Second thing that you should look for is cyclicality. That means that it goes through sort of a boom-bust period again and again. If you invest in a steel firm, then there are great times and then there are very bad times. Same thing it happens to mining, same thing it happens to a lot of commodity sectors. More the cyclical businesses, less the leverage should be. The third and the most important question, maybe the first question that I ask is governance. Is the promoter good man? Is he swindling money? Are there too many RPT, related party transaction in the firm? So basically, in some sense, we're trying to figure that promoter is actually a fiduciary duty. He is not it's not just his company, but it's also bondholders' company. It's also other minority shareholders' company. I generally would avoid a PEP, the politically sensitive groups. I will avoid strong men. So these are the 3 things: leverage, cyclicality, and governance.
So it's a common known philosophy that higher yield is equal to higher risk. Does it always happen with the debt market?
High risk does not necessarily mean higher return. Higher return will always come with a little bit of extra risk, and that risk can be treated. When I say treated, essentially means that in some form, by building a decent portfolio, you could potentially treat it well. There are certain companies, by checking their cyclicality, governance, and leverage, and many other things, the framework that you build, you could actually pick amongst many high-yielding bonds, the good ones. The 12%, 14% coupon may attract you, but the company must return the principal to you. And for that, it must not go bankrupt. So to that extent, that risk must be gauged well on day zero. My sense is that, if you have a cogent framework, coherent framework of actually assessing risk and diversify the portfolio, there is a decent case to make that bonds would deliver sustainably higher return versus fixed deposit. Okay? But as it always happens in equity, you heard the story that 90% of the traders lose money.
Yeah.
You heard these stories. We've also seen in mutual funds that very large majority of investors actually don't earn returns as much as the scheme earn, because investors tend to rotate money too quickly. They're not patient investors. Similarly, in bonds case, most people or many people will make major mistakes by obsessing over simply maximizing yield without understanding the risk which is associated with these high yield. So I think, as it is always in this place called money land, you only become rich by being super cautious.
Yeah. People behave in a certain different way. When they invest in equity, they are probably more conscious. They keep checking things every now and then. But when it comes to investing in bonds and fixed income, usually they invest it like passively. They just invest their money and just leave it behind, thinking there's nothing they can do.
So is the case in all other asset classes. Most people actually do a mediocre job or bad job. This is not a rocket science. It's not that you need a scientist to actually underwrite a good bond. You just need a decent application layer. Ask 5 simple questions. There are these chatbots available today. Keep asking that, I want to buy this bond. What is the rating of this bond? What is the risk in this bond? What is the leverage of the company? Has this company ever defaulted in the past? Has the promoter undertaken different large projects which perhaps can risk the company? Has there been a lot of related party transactions? You keep asking questions. In half an hour, you will get an answer, after interacting with your good friend ChatGPT, as to should you be doing this or not.
You mentioned that traders lose a lot of money, right? And when we look at the equity market, it's very visible when the stress is there. Price keeps rising, volume keeps spiking, and basically everything is transparent, and we know that something is going wrong with it, right? But debt markets do not behave in that way. So what are those early signs that will help a retail investor to understand that probably something is going to go wrong?
For the retail investor, unlike equity, as you said, these are well-documented stories. Unfortunately, bond markets are not as transparent. Not much of research is available. But there is a lot of still public data. First thing first, if a company is listed and the stock is behaving weirdly, the investor must ask, why is it so? Why stock prices are going down? And if it is going down for reasons such as newer set of competition coming in, demand is slowing, margins actually worsening, some commentary will be there. You must look and feel of it as to why it is happening, and it might just hurt you as a bond investor. So firstly, understand that equity is an asset class whose value come only after bond has been fully paid, right? So we as bond investors have the first claim on the firm's asset. Only after we've been fully paid, the equity's value will come. So there's a residual part. So, but equity still tells a story about the overall thing. So as a retail investor, if the firm is listed, I'll be continuously watching. 2 is that 8 or 10 bonds that you may have, make it a point that you once in a month at least, if not more, all those 10 bonds, run a small query. Literally run a query, make a decent prompt, and I'm going back to chatbots again and again because it's become so easy that the institutional grade intelligence is available to someone sitting in Udaipur today. So make a small query that, okay, these are the 10 bonds that I own, and can you tell me if anything incremental has happened in last 1 month, which actually can hamper my interest. I own a 3-year bond of this company, 2-year bond of this company. You can explain all of this, make a small prompt, save it in a Word document, copy this every month and run a query on one of the chatbots. I think purely from a playbook point of view, this is a better way to look at it. Now, there is one to know stress opening up, and two to do what to do with it. If things are worsening, then you should be ready to press an exit button. So in many transactions that you would do in bond, there could be put option, so you should be able to exercise them. Or your platforms may give you liquidity, so you should be able to exit from them. So all kinds of things. So both things, one is to know what's happening and then what to do if something is going bad. Most of the times, 8 out of 10 cases, you can sleep peacefully for 2 years, 3 years when you invest in a bond. In 1 or 2 cases, when you should be alerted, you should also have a playbook of what to do after that.
I hope you're enjoying this conversation till now and making notes as well. So do share them in the comments below, and the best one will get signed copy of Manish Tangi's book. So let's continue with the conversation. I have personally seen many people trying to build their portfolio in good times. They focus a lot about which instrument to invest in, how they can grow their money the most. But nobody talks about how to build their portfolio in bad times. So can you help me with that thing?
If you're a young man or woman, be sure that intermittently there'll be bad times. Every 5-7 years, we will go through some mess as a country or the sector that you've invested in. So I don't differentiate between good and bad times. Bad times, investing actually is good investing, because bad times give you a lot of opportunities, because bad times actually dissuade most investors to not invest, and therefore the risk premiums are higher, the stocks are cheaper, the bond yields are higher, and so on and so forth. Try and become a little bit more risk taker in bad times, and try and tame your risk taking appetite in good times. Basic first order ethic is this: be a little bit contra in your portfolio building. But then there are periods when there are extended bad times. Generally bad times last for a while and then they pay way for autumn. So winter is 2-3 months. Bombay, there's no winter. Yeah. In those times, generally look for other asset classes also outside of equity. People obsess a lot on equity, and I think we discuss about bonds a lot more. It's a different podcast, to the point that I'm first time discussing so much about bonds. And bonds are also good friends. And typically in bad times, bonds are better friends, okay? And because you contract a certain yield with bonds. So all that you have to avoid and protect yourself from bad bonds. So yeah, there are multiple ways of looking at bad times. Generally, your headset should be that in bad times, you be prepared to take a little bit more risk. But if it's sustaining for a very long time, then bonds are your friends.
Usually I've seen the opposite of it. Usually everyone, especially the youth, they think equity has charm to it. Equity investment that seems really attractive in comparison to the bond ones.
Yes.
Usually people attach bond investment with something as to what old people would do or what you would do for retirement. So they don't treat it equally. And that might be one of the many reasons that people are really, especially the youth, is really divergent towards the equity thing. If you have to tell the entire youth community today that you should have bonds in your portfolio, specifically that you mentioned in the bad times, how would you do it? How would you change the narrative?
First thing first, you're in mid-20s, my advice to you will be, first of all, work really hard. Then live a frugal life, save a lot of money. And then, because in mid-20s, you likely will not want to take this money out for very long, put most of this in either India Tech Index or NASDAQ and forget about it. But then youth is a very long period. And our politicians are called young leaders at 50.
Yeah.
So if you're 50 or 45, then yeah, you have to be a little careful that, they're going to be at 60, you'll not have job. You'll start to withdraw from your savings. And which is why the role of bonds, start to appear when the youth fades and the politicians' youth appear. So yeah, as you move forward in life, in mid-30s, the role of bond is a lot more. In mid-40s, a lot more. And then as you are crossing 50, 55, then, significantly more. So in a sense, bond is a good friend for older people for sure. But for youth, I would still advise put all your money in a tech index fund of US or India, and you're going to be in good stead. But generally speaking, now this is very broad. Now the problem is that no solution. All of us are unique. You're unique, so we need to sort of. I need to cut the solution for you, which is unique to you. So there are a lot of aspects to it. So generally speaking, don't put money in equity if you want that money anytime soon, which is 5-year, 10-year. So if you have a 10-year, you don't need the saving back to buy a car or a house, then put all of that in equity. But if you want money in 3-year, 5-year time, then don't put that money in equity. So generally, I'll give you a basic principle.
Okay.
Don't run asset-liability mismatch in life. Okay? Consider equity as a 15-year bond.
Okay.
Just think, and put all your savings, which you do not want to touch for 15 years, in equity.
All right.
Consider high yield bonds also as the underlying instruments duration. So if it's a 5-year bond, then assume that you will not be able to sell this for 5 years. So don't invest in a bond for in a 5-year bond for 3 months, 6 months. So don't run an asset liability mismatch. Liability meaning your money.
Yeah.
You do not need to take this out for 15 years, then equity, 5 years, 3 years, then high yield bonds. But then there is going to be money out which you require after 6 months. Then you should not go and buy high yield bonds for 5 years, 3 years.
Yeah.
You should put money in a low duration fund of a reasonable fund house, or short-term bonds if they're available. So basis your asset liability, basis your how much savings you have and when do you want it back is how you should decide where to invest in.
In this long career of yours, what do you think is a mistake that didn't reveal itself initially, but later you thought, okay, this was the turning point?
I think in last 15 years, the big mistake was that 2 kids who came to me in early 2010 made a pitch to me. Both are from Bangalore. All of us know them now. Both of them are unicorn now. And it came to me so much close that I could have invested at a very early stage, and I didn't. When you have an obsession with mortality, you tend to then let go of opportunity which could be a million bagger. And so to that extent, I think that was a super stupid mistake of not investing in them early stage.
I think you have gotten my curiosity now. Can we talk about who were these people and do we know it?
All of us know them.
Okay.
All of us know they're big guys.
Okay. And what was the first investment that you ever made? And in hindsight, do you think you could have done it more better? Now that you have?
A total stupid mistake. Again, back in, I think, 2002, I bought a company called HPCL. First equity investment ever, driven by the narrative, the idea of privatization, big narrative that, these firms will eventually be privatized and make a lot of money. I think sold about a few months ago. It's 10, 11x. Had I invested in Nifty, it would have been 25 times. I don't have the winner's curse, so I made a very stupid call of actually investing in HPCL. And I know a lot of people will hate me for this, that I generally think that, government firms, however good and great they may be, their primary ethic is to actually bring public utility, do public good. They also may make profit, but that's not the primary purpose. And therefore, the learning from HPCL episode is they stay off PSUs. These firms will survive for very long, but their basic purpose is to actually do good to the people, not to make money. And when you invest in the firms, the basic purpose is to make money.
Let's come towards this frenzy going on over the fire and everything. So let me ask you, what do you think should be the target corpus for somebody
Fire.
who wants to get retired?
What is fire? Fire is the
Fire
early
is the-
retirement.
Financial independent, retire early.
Why would you retire ever? I don't understand. Well, you should never retire. My dream is to actually say goodbye to the world being in office. No, why would you retire? He has gifted us cognition. As long as there are physical abilities that we're blessed with, we must make a difference. We must do. We must work. So I don't think you should obsess over that some number. As I said in the beginning, work super hard. Live frugal life. That basically will mean a lot of investment. Understand where to invest in, and invest in companies. And then, if you have a lot of money, then try and create magic of it. Start your own podcast. Start a news firm, build something, create some magic. My dad is in mid 70s. He's such an amazing dude, banker. All my finances are taken care of by him. I'm an idea guy. He's a guy of execution. He's not retired. He shouldn't retire. You shouldn't retire ever.
Hey, if you think you resonate with these stories and you think you have one worth sharing too, then please fill in the form in the pinned comments below and you can get featured on Wint Wealth.